Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Beyond Meat.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
We really have to start with the hard numbers, right?
Yeah.
Because they really set the stage for the bear case here.
Oh, absolutely. The recent performance has been, let's just say, brutal. And you really need to understand the scale of it.
So what are we looking at?
In the third quarter of 2025, net revenue was $70.2 million.
Which is a drop.
A big one. That's a 13.3% drop year over year. And what's maybe more concerning is management's guidance for Q4.
They're expecting it to go lower.
Yes. They're guiding revenue even lower, somewhere between 60 and 65 million. They are telling the market very clearly the base is still shrinking.
A revenue drop like that is deeply concerning. But what did that actually do to profitability? Because for a company with this much debt, that's what survival hinges on.
It hit the margins hard. That is the real story here. The gross margin just fell off a cliff.
Okay.
It went from 17.7% a year ago all the way down to a razor-thin 10.3% in the third quarter.
Wow.
But the number that really spooked everyone was the net loss. It widened dramatically to $110.7 million.
Okay, let's pause there because a loss that big needs some context. $110 million. That's not all cash just walking out the door, is it?
No, and that's a fantastic point. A huge chunk of that was driven by non-cash impairment charges and restructuring costs.
So what does an impairment charge actually signal to you, the investor? What does that mean?
It's a sign that the company is having a moment of reckoning. They're looking at their assets, machinery, inventory, you name it, and admitting their future earning potential is way lower than they thought.
So they're essentially saying, we overvalued this stuff before.
Exactly. They're writing it down, admitting past investments were inflated. For you as an investor, it means they're clearing the decks. It hurts now, but it theoretically allows for a healthier P&L in the future.
Okay, so let's unpack this. The numbers look, undeniably rough. The market has priced in some serious pessimism. But is there a scenario where this weakness, this reset, is actually a good thing?
That is the entire turnaround narrative in a nutshell.
A hidden opportunity.
The key here is leverage, not just financial leverage, but operational leverage. Because they're working from such an incredibly low base in both revenue and margin, even tiny improvements can have an outsized effect.
What kind of improvements?
Things they can control. A little pricing discipline, better use of their factories. These small wins can create huge percentage improvements in gross margin and EBITDA. They only have to clear a very, very low bar to impress the market.
So if they're not just chasing sales anymore, what is the new focus? What is management telling people?
The explicit goal is a total shift in mindset. It's achieving EBITDA positive operations. That is the new North Star.
So no more growth at any cost.
Gone. That mantra is dead. Now it's pure efficiency and survival. It's all about cutting manufacturing costs and just making better use of the buildings they already have.
That makes perfect sense given the margins.
Right.
But here's what's interesting. They're still spending money, right? Isn't CapEx a sign of growth, not cutting back?
Right, and that's the critical nuance that really supports the bull case. They are investing, but it's targeted. It's all going toward increasing manufacturing efficiency.
How much are we talking?
In the first 9 months of 2025, they used about $9.3 million for capital expenditures. This isn't just keeping the lights on.
It's strategic.
It's an investment in self-help. Spending money now to save much more money later on every single burger they produce, it's essential to the plan.
And they're also refreshing the product line with things like the new chicken and steak items. How does launching new things fit into a cost-cutting plan? That seems contradictory.
It's a fair question, but it's part of the same margin-focused strategy. They're not just throwing things at the wall.
So they're trying to find higher-margin products.
Exactly. They're broadening the portfolio to find categories that can command a better price point than the core burger. It's about a better mix of sales.
So for the valuation, the idea is that the stock can go up even with flat revenues.
Precisely. If they can show rising margins, the market will reward them with a richer earnings multiple down the line. The street will forgive a flat top line if the profitability is healing.
Okay, let's pivot to the balance sheet because this is the part that, keeps people up at night.
This is the core of the risk, absolutely. For anyone looking at this company, you have to stare the debt situation right in the face.
What are the numbers?
As of Q3 2025, they had about $131 million in cash.
Which sounds okay until you hear the other number.
Until you see the debt load of approximately $1.2 billion, it is an incredibly high degree of leverage for a company that's burning cash.
And they are burning it aggressively. Net cash used in operations was $98 million for the first 9 months of 2025. At that rate, I mean, how long can they even last?
That burn rate is the existential threat, there's no question. But there's a vital piece of context here for the contrarian investor.
Yep.
Over that same period, net cash from financing activities was $87.8 million.
Meaning they can still raise money.
It means they still have access to capital markets, they have levers to pull to give them enough runway to execute these cost cuts.
So if you combine the high debt, the cash burn, and this little window of liquidity, the argument must be that the stock price already reflects a huge chance of failure.
Precisely. The price today, hovering around $1, basically prices an insolvency. So for an investor willing to take that risk, the combination of cash on hand, access to financing, and this targeted capex, it supports the view that there is a non-zero path to survival.
And any good news could cause a big reaction.
Any sign of break-even or positive EBITDA, even at this smaller scale, could cause a sharp re-rating of the stock because the market is expecting the absolute worst.
Okay, let's say they survive. What about the competitive edge? This whole plant-based category is so crowded now. What's their moat?
The moat isn't about profit right now. It's about scale and infrastructure. Despite all the headwinds, they still have one of the most recognized plant-based brands in the world.
And the distribution networks.
The first-mover advantage and those existing relationships with fast food chains, major retailers, food service, that is incredibly difficult and expensive for a smaller competitor to replicate.
You can't just wake up and decide to supply a global QSR chain.
Exactly. The supply chain complexity is a massive barrier to entry. Beyond Meat's infrastructure is already built. It's underutilized, yes, but it's there.
And what about the big picture? The whole health and sustainability angle, is that still a driver? Or are people just worried about the price of groceries right now?
The secular drivers are still intact, even if they're overshadowed by inflation right now. The positioning around health and sustainability is a fundamental differentiator from conventional meat. And long-term, regulatory pressures on emissions and agriculture are only going to get stronger.
The moat is really about having optionality for the future.
That's the perfect way to put it. It's optionality. If a government imposes a carbon tax on meat or climate policy shifts dramatically,
they're ready to go.
They are one of the few scaled global platforms ready to capture that renewed demand instantly. They're a turnkey solution.
Let's look at the stock chart and sentiment. It really reflects this whole battle, doesn't it? Trading well below its moving averages, yet we've seen these huge short-term spikes.
Yeah, a 7-day return of over 24% recently. That's a classic sign of a deeply distressed name.
What does that kind of move tell you?
It points directly to bottom fishing and intense short-covering rallies. Sentiment is so negative that it creates high convexity.
Meaning any little piece of good news can send it flying.
A disproportionately sharp rally, yeah, because so many people are getting against it. And that sub-$1 level becomes a huge psychological zone for speculative buyers.
But we have to touch on the other issues dragging on sentiment. It's not just about sales. There are serious governance risks, right?
Absolutely correct. You have to factor this in. There are ongoing investigations by multiple law firms into potential securities fraud.
Related to what specifically?
Related to an impairment charge and then delayed financial results. This adds a layer of tangible litigation risk, and it just poisons the mood for investors. You saw how the stock dropped after they delayed results. Trust is fragile.
And yet, people are still trading it heavily.
Yes, the options activity is significant. Traders are re-engaging with it as a high-volatility binary opportunity. They're betting that the self-help plan can override everything else.
Okay, let's wrap this up. For the listener, what is the single biggest risk, and what are the catalysts to watch for?
The number one risk is still structural demand softness. U.S. food service was down almost 30% in Q3. The whole category is seeing fatigue. If demand doesn't stabilize, that $1.2 billion in debt is an existential threat.
So why should you be tracking this name right now? What's the key event?
The next crucial event is Q4 earnings and the full-year outlook for 2026. That's the whole ballgame.
What do you need to see?
Clear, quantifiable evidence of gross margin stabilizing or improving, and a clear timeline to getting to EBITDA positive. That's the only thing that can break this bear narrative.
And on the flip side, what's the blue sky scenario, the big surprise upside?
Potential M&A is plausible. Given the depressed valuation but the strong global brand and IP, they could be a very compelling target for a large food conglomerate that wants into this space without building it from scratch. The investment thesis here is clearly high risk, high reward. It's framed as a deeply distressed turnaround trade over the next 12 to 24 months. The bet is that margin stabilization potential outweighs the liquidation risk at these prices. The key takeaway for you is watching if they can finally pivot from a growth story to an efficiency story.
That's an excellent way to frame it. Thank you for joining us for this analysis. Don't forget to subscribe for your daily look into the market, and we'll catch you next time on Smart Wealth with Joshua.